My name is Dustin Owen. I'm the Regional Vice President at Watestone Mortgage. With me today is one of my top loan officers, Kevin Murphy. And in this video, we're going to jump into how we pre-qualify home buyers. When we pre-qualify home buyers, we're going to jump into the acronym P.A.I.L. And P.A.I.L stands for
Property, Assets, Income, and then Liabilities.
Think of it this way. Think of it as a chair. A chair has to have 4 legs in order for it to sit firmly and comfortably. The minute one of those legs becomes wobbly or broken, then your chair is no longer sitting comfortably nor stably. Someone buying a home, same type of logic applies. We need to make sure that all 4 legs of the chair are intact. That's the property, the assets, the income, and the liabilities. So Kevin, when we're looking at the P, what is that you're looking at in terms of the property?
Property, we're looking at what type of property. So you're trying to buy, is it a single family home, condominium, townhome, manufactured home, or like a duplex, triplex, or quadruplex?
And this matters because certain loan programs won't lend on a condo, or they won't lend on a duplex, or certain loan programs require different down payments if it's a manufactured home. So knowing up front what type of home your buyer is looking to purchase matters. What's another key component of the P in property?
How you're intending to use the home or occupy it. So are you going to occupy it as a primary residence, meaning you're going to live there? Is it a second home, which means you're going to vacation to the home a couple times a year? Or is it purely for investment purposes, meaning you're buying it to rent it out?
And the reason why this matters is that if you're buying it for a primary, there's a good chance that you can utilize 0% financing options and down payment assistance options. But if you're buying the home as an investment, now you're required to probably put 15 or 20% down just to purchase the home. And there's certain loan programs that you can't use when you are buying a home as an investment. And those loan programs would be
FHA, USDA, and VA, so your government A loans.
Perfect. Now the A stands for assets. And when we're looking at assets, it's not just how much money someone has in the bank. It's actually how much they have in the bank and that they're allocating to go towards a transaction. But even that, Kevin, what more goes into someone's assets as it pertains to them purchasing a home and obtaining financing?
Where that money is coming from. So is it coming from just savings over time that you've been accumulating? Are you borrowing or taking money out of a stock account, taking a loan against your 401k? Perhaps you have a grandmother, grandfather, mother, father who wants to help gift you some funds. Those are the ways that we would look at, and making sure that none of those have a really large deposit.
Correct, because government regulation requires that lenders have to source all large deposits, and if someone has a large deposit, let's say from a credit card advance, that very well would jeopardize their financing. Or if someone's getting gift money, but they are trying to buy an investment property, that may jeopardize their financing. So understanding not just how much money someone has or has allocated, it's also how long has it been in their bank account and what's the source of those funds, because depending on the transaction type, the source of the funds may or may not prevent someone from obtaining financing and closing on their home. Now we jump into the I. The I is income. And is it just how much money someone's making today, Kevin, or is income a little bit more involved when we are pre-qualifying a home buyer?
It's definitely going to be more involved because we're going to try to figure out, are you an hourly employee that maybe we need to use some overtime? Are you just a straight salaried employee? Maybe you happen to be self-employed. Each one requires different documentation and different timelines for how we are able to use that money.
And if you're using overtime, have you been receiving overtime for the past 12 to 24 months? Is it likely that you're going to continue to get overtime? If you're commissioned, we're probably going to have to average that income over 2 years. Same thing for bonuses and self-employed. So understanding on the I in your P.A.I.L, or the third leg of the chair, it's not just how much money your buyer makes, it's also the source of that income and how long they've been receiving it. The last part is L, and L stands for liabilities. Liabilities is more like your credit. But is it just credit score, Kevin, or is it a little bit more involved in credit score?
Definitely has a lot to do with credit score, but it is more involved. It's looking at what type of debt you have, how long you've had the debt. So do you have an auto loan? Do you have credit cards? Do you have student loans? Are there personal loans out there? And then we also like to look into, too, is there anything bad or derogatory on your credit report that either we can fix if we need be, or maybe there's a wait period assigned to it? Something like a bankruptcy or a foreclosure has a specific time you have to wait before financing again.
Correct, because some loan programs may only require 2 or 3 years after a bankruptcy or foreclosure, where others, it's 7 years. As well, when we look at liabilities, we have to ask legally if they're obligated to pay alimony, child support, or separate maintenance, and that factors into their debt to income ratio. So when we're looking at the L, it's more than just credit score. It's what are your monthly debts? Do you have any derogatory events? And how do these liabilities factor into your income? Because every loan program has a maximum debt to income ratio. This concludes our video on pre-qualifying homebuyers.